Mr. Ferguson, welcome. Good to have you with us.
Thank you. Nice to be here.
So which is it likely to be, in your view? Soft landing, stagflation, recession, what?
I think there are a couple of things that we know for sure, and there's a lot of uncertainty, as Steve was saying. What do we know for sure? We know that inflation is high and likely to go higher. We also know, as Secretary Yellen said, that we start in a place with relatively low, very low unemployment, increasing though still relatively low labor force participation. And so I think we have really quite a brew here that they're dealing with. I heard the clip that where Secretary Yellen said she doesn't expect a recession. I think no one really expects a recession, but the odds of a recession have certainly gone up because of the challenging circumstances.
Do oil price spikes, and we had one briefly earlier this week to 130, but it's come back down a little bit. Do oil price spikes cause recessions, or are they coexisting characteristics of many recessions?
Well, I think in the past, the last time we saw oil price spikes that were associated with recessions was back in the 70s. And there are two of them, 73 and 79. I think Steve said a couple of points that were really important. First, it was much more of a tax on our economy because the money was flowing overseas. We now are much more energy independent. Secondly, we actually use less oil than we used to. I've seen statistics that say that, the equivalent for what, this kind of oil would be basically $200 per gallon oil would be the equivalent of the kind of spike that we saw in the 70s because we have become, much more energy efficient. So I think the challenge around oil is that it is a drag for sure. Steve's right, where those oil dollars go does matter. But it certainly takes money out of the consumer's pockets, and it increases the uncertainty that the Fed has to deal with in terms of how to deal with inflation. So challenging situation because of oil price spikes, often associated with recession, not clear that they cause the recession.
Roger, it's good to see you. Take us through, you've been in the boardroom there in critical times, things like 9/11, if I'm not mistaken here, and I think I covered you doing that way back then. If you only looked at the economic data, 3.9% unemployment rate, 7.9% inflation rate, you might say, hey, let's raise 100 basis points today. And yet you have this uncertainty over war. How does that factor into the boardroom and the discussion there at the FOMC?
Well, I think you said it very, very clearly, which is the situation at hand is one of high inflation, well above the 2% target. Unfortunately for them, for my friends and former colleagues at the Fed, this is due to a supply shock, and we know that monetary policy alone cannot cure a supply shock. So I think the answer is go slow, continue at a 25 basis point pace for the next maybe 2 or 3, maybe 4 meetings, perhaps take a pause and see what happens. Signal clearly that you've got your eye on the inflation ball, but also say very clearly that you have to be nimble, as Chairman Powell said, very flexible, and recognize the downside risks. So I think this is one where you sort of inch along, knowing that you can't set it and forget it, and literally making decisions every meeting, but with a lean towards fighting inflation because you need to keep inflation expectations under control.
Roger, without debating what exactly happened in the 70s, one of the ideas out there was that the Fed monetized the oil price spike. It provided the fuel for the fire. Does the Fed have time to wait? I completely agree with your idea, but isn't the risk there that the Fed essentially monetizes the price spike?
There's a risk to that, for sure, but recognize that they started a place where longer-term inflation expectations only a smidge above, what their long-term goals are. Without getting too technical, if one looks at the inflation expectations sort of 5 years out, starting and going from 5 years from there, it's roughly around 2.3%. So close to the 2% range if you think further out. So the main point there is inflation expectations are not yet, beyond their control. And that gives them, I think, the opportunity to go a little slower. There's also the expectation, as you well know, that, more oil can come into play. They're discussing with Venezuela, working hard with OPEC Plus to see if they can produce a bit more. And so this is not, the game is not lost yet when it comes to energy. And to the earlier point, we are not as energy dependent as we used to be and not as dependent on foreign producers as we used to be.